All right, we're live. Welcome to Coach's Playbook for September the 15th, year of our Lord 2020. What a year it's been. I'm back from my sick bed last week. I'm all good now. So that's good. And back just in time to talk about cross asset correlations, which is one of my favorite topics. But first, Mick, you have a shout out today?
I do. Big shout out to James Barry. He's up about $5,000 trading the NASDAQ right now. And this is kind of typical performance that I've seen out of him in his, short couple weeks trade. Has been really building his account on a daily basis, and it's growing nicely. So hats off to you, James.
Nice. Is
That's
he
exciting.
related at all to Michael Burry?
I'm not sure.
Oh, okay. We'll have to ask about that. Other good trader. Yeah, so we thought we'd kick off today. So for those of you, cross-asset correlation are basically the correlations between different products and assets and how much they move in tandem with each other. If you're familiar mathematically, they do it through regressions, plotting one against the other. They can be on different time frames, different products. Some are very strong, some are very weak, and they both can benefit you. Obviously, people who are in the portfolio theory, they're always looking for things, optimizing for the right number of REITs and stocks such that you find things that have positive return but are negatively correlated. But we're more micro because we're traders, right? So, Dan, maybe you could kick us off and talk a little bit about how you use these in your career.
Absolutely. Well, first off, the market correlation was something really big for us, especially as a bond option trader. Our biggest thing was we carried large option positions. So every morning we came in, and obviously direction of the bond is the most important thing for understanding where our position's at, where our P&L is at, and everything of that nature. But the first thing we would do every morning we walked down on the floor is we'd look up at the board, see where the S&Ps were. If SPOOs were up, we were thinking, okay, we may see, because bonds to equities are inversely correlated. In theory, that's how it's been in the past. Obviously, things are a little different. It's 2020, but that was the first thing we looked at. We looked at where the S&Ps, where are our equities screaming higher? If so, should we expect bonds to break to start to hedge against our position? So that was always the first thing we looked at. If we saw a big pop in one, we were expecting the other one to start to break. And so that was the first thing we looked at. And so for me, one of my favorite things to do is look at markets that are correlated and inversely correlated. I love watching gold to the bond. I love watching the dollar to pretty much anything. And you have to also do on the flip side, there are markets that move in tandem together. The equities, prime example. Russell, NASDAQ, Dow, S&P, they like to move in tandem in theory. And you really have to take this approach of understanding it. Just because one's moving this second doesn't mean they're all going to go. So it's just for me, it's a sense of getting an idea of where this market can start to go. I'm not going to trade off that directly, but it's something I'm going to start to look for. So that's kind of where I start when it comes to correlations.
And we'll go to Mick before we have a slight contrarian here in Mr. Hoagland, who's getting ready to throw some hate on this party. But first, I think it's important to know why something's happening to something you're trading. And you said you're always looking at the dollar. That's a good example. Everything's denoted in dollars. So, you don't want to be trading something if what you're really trading is a big move in the dollar one way or another. Or that's how I felt a lot of times. And Mick, did you want to get in a little bit about some resources to share and sort of time frames?
Sure, definitely. I think when it comes to discussing correlation, something that's very important is, what time frame are you talking about the correlation on? There's a great website that I use, mrci.com. It's Moore's Research. It is a free publication. A lot of information in there that I look at from time to time. One of the things I really like using there are the intermarket correlation charts. And I like these ones so much because you could say, the equities are correlated. Yes, they have close to 100% correlation, like Danny mentioned. Dow, NASDAQ, Russell, S&P, they're highly correlated. They're equity indices. They are a little bit different because they all, different stocks make up those. But you have correlations changing over time. You could have inverse correlations. You could have, positive correlations. It's important to frame out, what time frame is this correlation on? Is this a new correlation? Did something just flip from being inversely correlated to, positively correlated? So the website I referenced, mrci.com, they break it down anywhere from what is the 30-day correlation on, any of these products, all the way out to the 180-day correlation. So it gives you a bigger picture, over time. In the last 180 days, these markets have been correlated, but what is their correlation now? I think it's really important. One other thing, kind of in line with correlations, but not so much talking about correlations. I think for, traders who are looking to trade or even spread equities, usually you'll see pretty tight correlations in the equities, as we've repeated here a few times now. But when it comes to potentially buying the Nasdaq or the S&P, and you're looking to which one do I go long, they're both up on the day. Typically, you would want to buy something that's the strongest out there as opposed to the laggard. A lot of people might see the Nasdaq up 1.5% and the Dow's only up 0.25%, and they're like, well, I think that the Dow can catch up to the Nasdaq. Maybe it can supersede the Nasdaq as a net change on the day, but you're better off buying the market that's the strongest, because that's the market that's got more people aggressively buying it. They say buy strength, sell weakness. If you're looking to pick one of the 4 equities to trade and go from the long side, buy the strong one out there. I think it's not always going to be the case, but I think that's your safest bet.
Yeah, the strongest momentum there.
Mm-hmm.
So Hogue,
that website is dropped in the chat here really quick. I just want to make sure people knew that was the link I dropped.
Yeah, check that out. It's great and it's free.
Yeah, it's very interesting stuff too. So Hogue, why should we not find it interesting?
I never
Boxing them in, Jack.
I never said that that we shouldn't look at it or that it doesn't have its usefulness. I remember in the S&P is before the first time I ever saw the yield curve invert. Basically, the S&Ps went tick for tick opposite the bonds. It was something that we certainly looked at, and it was something that everybody was pretty much aware of. Now, I'll never forget that when that yield curve inverted and everything turned upside down on us. I'm like, what the heck just happened? It took somebody to tell me, hey, looks like the yield curve inverted. Things are going to get a little bit crazy. So there's certainly a usefulness to it. It's something I will look at as part of a bigger picture, but I don't think it's anything that I'll basically take the trade decisions on. Like Mick was saying, if I'm going to be looking at the equities and I want to buy the strongest of the equities, it would probably lately be the Nasdaq. The Nasdaq has taken out and held above the all-time high back in February very well. It seems to have the furthest to fall. But when you're looking at a market that is continuing to rotate higher and higher, that you want to buy on weakness, you want to buy the one that is presenting as the strongest one. So I completely agree with that. On the other side of that coin, I mentioned to me, it's not something that I'm basing that much of a percentage of a trade decision on. I'm going to be looking at it maybe, and I say, okay, it's in correlation. This looks like good trade level. But I'm one of the people that say the information that I need from the market that I'm trading is already in that market. The market is basically, already saying or telling me where it's trying to go, how good of a job it's doing getting there. It's my job to find a good way into it. And, if it's a correlation that puts me into it, wonderful. There isn't anything that traders look at or traders, think about that isn't useful at the right time. So I was not going to cast shadows on correlation. I just think that there's more information coming from the actual market that you're trading than you're going to be able to glean from the correlations.
Yeah, I would have to add on that, John makes a good point here. Correlations. We talk a lot of times about a bunch of different ways of looking at these markets. It's hard to make your trade decisions, especially in a day trading standpoint, off of one indication, be it a correlation. If those things invert with the yield curve inverts like that, yes, that forces us to start to look elsewhere to find those opportunities. It helps us kind of get some validation when it comes to execution. We're not going to trade just because one thing says this is what's happening. We have to have that other validation.
I gotta tell you, it sure stripped my gears when that first time I saw a yield curve inversion and everything went upside down. What do I do?
Yeah, I think that's more. I think, Hogue, you're absolutely right as far as if you're just putting on day trades. Yeah, I would say the market's got all you need. I think where it really helps to understand all the correlations is that gives you sort of a holistic view of everything that's out there, so that you can be comfortable making decisions on a quick basis. Like, something happens to the dollar and I have a feeling where everything should be and what looks outside of that. I think it just makes you a more savvy consumer of economic data. And then, oh,
I got lost.
The voice of Top
see
Step
you.
Trader.
Hogue's been thrown into the phantom zone there.
Oh, we got another camera.
Yeah, let's go back to camera 2. No, I completely agree. It's important for every trader, day trader, long-term trader, whatever it is, to have a good idea or a good view of the market in the longer time frame. And I'm still on camera 1 here, so let me see if I can fix this. Go ahead, guys.
Just finish it off on that. Yeah, I think you're always going to be best positioned to make your trading decisions off the market that you're trading. It's good to be aware, like Jack mentioned, have the holistic view. It can kind of make you, ask questions or be curious about things or keep an eye on other things, but you'll probably be best off. You don't want to, base your, trades on soybeans with, what's corn's doing. Granted, there's a pretty big correlation there, but, make your decisions mainly off the market that you're trying to, you're taking risk in.
Absolutely. Just want to shout out to everyone really quick in the comments here. Alan, Tanya, Rob, Miguel, Nick, Joshua, Subconscious, Art, and Charles. Joshua did have a question from us and just asked if we can explain the table on the website that I just shared and what it means, how to read it.
Without seeing it, can I take a guess?
Take a guess.
I presume it's lined up with assets down one side and assets on the other.
Yeah.
And like a multiplication table, you go to the middle.
That's exactly right.
Exactly.
And if you hover over the product symbol, it gives you what the product is, and you just meet in the middle and it'll give you a number. And if it's negative, there's a certain inverse correlation. If it's positive, then you've got a positive correlation, and you can, flip through the time frames 30, 60, 90, 120, 180 days.
Yeah, and -1 would be perfectly inversely correlated, just moving tick for tick opposite. +1 would mean that they're 100%. They're the same product. So if you go to ES and then ES, their correlation will be 1 because they're the same product.
Well, it would be 100 the way
100.
the table reads.
All right.
You were close, Jack. You were close. It's percentage.
You're not
it's
looking
percentage.
at the chart. Yeah,
it's percentage.
It's a percentage.
So
Okay.
for a prime example here, if you looked at ES and YM right now, there is a positive 96% correlation on the 180-day chart. So yes, in theory, they should move in conjunction with each other, but there's still a 4% chance that they may move opposite of each other. And that's markets. There's always chances, there's probabilities, and it's trading to those probabilities.
Absolutely. All right. Dan, did you have a quote for us today to sign off right now?
I absolutely do. Real quick. And we just have some questions here. I want to make sure, we get everyone. Ute G, and I hope I pronounced that right. Good to see you there. Subconscious just asked, is Coach's Playbook running every Tuesday and what time? Yes, every Tuesday we will be clicking live at approximately 11:20 a.m. Central Time for Coach's Playbook. Joshua, glad we can help. And Charles says, wow, this is gold. We appreciate that. Oh, another question here. Would you look at correlations to hedge your position? And the message got retracted. To answer your question, Joshua, that's how we, when I was an options trader professionally, that's what we would use. Correlations was not specifically to hedge at the moment, but it forced us to start paying attention to where we might have to expect and what direction we might be expecting to hedge. We weren't going to do it instantly unless our delta said otherwise.
Right on.
Sweet.
You know, one thing I'll say about hedging when you're using correlations, hedging can be fine. Make sure you're thinking about, what you're doing. If you're gonna, if you're thinking about hedging and you're going long 3 NASDAQ and you're going short 3 S&Ps, maybe you don't need to even put that hedge on. You could just do one contract. You can always scale back your size, to limit your risk too, instead of trading larger and then hedging larger size on the other side of that.
The one thing I learned the hard way about trying to hedge or using like calendar spreads or corresponding markets, if you're not careful when you're legging on spreads, all you're really doing is guaranteeing a small loss.
Mm-hmm.
That's all.
Yeah, you lose your edge when you're legging that stuff in most cases.
Absolutely.
Also, I feel like sometimes people jump in and hedge things when the correlations are breaking down, and you just get worse and worse and worse.
Yeah.
So it's just always
a hedge doesn't always hedge your losses, because sometimes your hedge could go, you could lose on both legs.
Yeah, I've seen that in bonds before. I'll tell you what. All right, so if there's any more questions or otherwise, Dan, do you want to?
No, just one last shout out here to Salem, and then it's very beneficial. That's what he says. And then Joshua says, I learned a lot, great value. Thanks for your time. So thanks for the awesome comments, guys. I do have a quote here today. Has nothing to do with market correlations or anything like that. There's really not any good inspirational quotes out there about that one.
I'll find one.
But I thought this was actually kind of nice, especially as it is in trading. You hear a lot of times about, before traders became successful, they had that where they kind of stumbled a little bit, or they started to show some success and then they lost it all. And I thought this was kind of cool. It's okay to be a glow stick. Sometimes we have to break before we shine. And that comes from Jetta Selner.
I like that one too.
I thought there was gonna be some famous DJ. The glow sticks. Well, anyway, that's all we got for today. Yeah, thank you so much. Just the way we're set up on Zoom, I can't see the I'm not trying to cut anyone off as far as the questions go, but only Dan can see your questions. So
well, everyone can too. They can just go to our YouTube and pull it up like I have it. But hey, I'm just giving you a hard time.
Of course. You know what? I deserve it. Everyone deserves it sometimes. All right, everyone. Thanks so much for stopping by. We'll be back next week. But in the meantime, Hogue, you want to sign us off?
Yeah, sure. Just manage your risk out there. There's always opportunity. Look for those asymmetric opportunities with a little bit of risk and a much greater profit potential. Love to see you get out there. We'd love to see all of you succeed. Get out there and trade well.
Trade well, everyone.